So without further ado, let's get today's presentation started. We're going to be talking about technical analysis today, gaining confirmation and managing risk. And before we do that, we do have a little bit of housekeeping to do, so I've got some disclosures to read. Any screenshots, charts, or company trading symbols mentioned are provided for illustrative purposes only and should not be considered an offer to sell, a solicitation of an offer to buy, or a recommendation for the security. Investing involves risk, including risk of loss, and technical analysis focuses on market action, specifically volume and price. Technical analysis is only one approach to analyzing stocks. When considering what stocks to buy or sell, you should use the approach that you're most comfortable with. As with all your investments, you must make your own determination whether an investment in any particular security or securities is right for you based on your investment objectives, risk tolerance, and financial situation. Past performance is no guarantee of future results. We are going to be doing a live demonstration later on today, and we'll try to use some real-world examples. So bear in mind, when we bring up those individual stocks or ETFs, whatever we bring up to show, as we said at the beginning of this disclosure, it's not a recommendation. It's just for illustrative purposes. So what are our purposes and objectives today? Well, today, this is really the fourth part of a four-part series. We do talk about some of the earlier topics just to make sure that they're fresh in everybody's mind, to make sure. The first one was done almost 4 months ago, so we want to get everybody back on the same page. But ideally what we're going to talk about is really what is risk, how can you manage it, and what are some of the things that you can do to manage risks that you have once you've quantified what they are. We'll also be talking about confirmation, and from the beginning of this series we've talked about confirmation a lot. It's a big part of technical analysis. We're always looking for confirmation. So we're really going to be stressing a lot of confirmation and risk management today. We'll talk also about some of the limitations of technical analysis. And with that, let's talk about where we've been so far. Just in case you've missed any of these previous ones, Robert, you want to give us a brief description of the 3 preceding webinars that we've done in this series?
Yeah, thanks, Brian. And this is Robert Kwan on the desk. Brian's my teammate here. So for those of you who have attended the entire series, welcome back. We appreciate you taking the time. But again, as Brian mentioned, we will touch upon some previous topics. So a quick recap. Part 1 was literally the building blocks. And that's where it needs to start. That's where you look at price behavior, trend and off, support, resistance, and the concept of breakouts and things like that. All right, part 2 was technical indicators. We covered a few specific ones, but we just kind of talked about kind of the different types of indicators that are out there, volatility indicators, price trend indicators, momentum indicators, and so forth. Reason why we did them in that order is many indicators rely on an assessment of price as part of their interpretation. So for those of you who are kind of new to technical analysis, if you're starting with indicators, you got to go back to part 1, which is, again, assessing price. Part 3, we started looking at charts, chart patterns, and specific things like candlestick formations and so forth. So bringing everything together, what this does is it gives us a trading process, right? Trading is about making decisions and managing risk. This is why this is the last part, in my opinion, the most important. And technical analysis gives us a method, okay, to make those decisions and to manage that risk. So moving on to what we're trying to cover today. In a second, Brian's going to introduce us to Dow theory. If you're not familiar with it, one of the biggest things that it does, as Brian mentioned, is introduces us to the concept of confirmation. All right, then we're going to go and move along to trends and trend confirmation. Look at that in just a moment. We're going to cover some risk management indicators. And again, last but not least, we're going to talk to you about managing your trades and controlling your risk. Again, there's really no prototype for a successful trader, but there's almost one universal thing that every unsuccessful trader does, and that's skipping this last part. And throughout and towards the end, we'll also look out for any questions that you guys have in the audience and try to address them in real time for you.
Yeah, let's talk about some theory. So really, at the end of the day, Charles Dow is pretty much credited with introducing technical analysis, or being the godfather, so to speak, of technical analysis. And really, one of the main tenets of Dow's theory was this idea of confirmation. Okay, he was always saying that you needed to have something confirming your hypothesis, essentially. And when he looked at various markets and various stocks that were trading, having one signal was not enough. So if he looked at the stock and he saw the price was rising and he thought, well, it's going to continue rising, that wasn't enough. He was always looking for more confirmation. And what he's most famous for to this day is the Dow Jones Industrial Average, right? Everybody knows the Dow Jones Industrial Average, and he is the person who created that. And having a Dow Jones Industrial Average to him didn't mean the end-all, be-all. There was more that needed to be used to get confirmation of whether stocks were rising or stocks were declining in price. And one of the things that he used in the beginning for confirmation was rails. So he came up with a rails average. Nowadays we call it Dow Transport Average, and he would look to those two to be concurring with each other. So if the Dow Jones Industrial Average was going up, he'd look for confirmation in rails to see that rails was going up as well. And it makes sense if you think back. I know that things have changed a bit, but if you think back to that time, the early 1900s, he was looking at it from a perspective of, okay, if companies are building things, they have to be shipping them, right? That's where the rails came in. Back then, the country was very dependent upon rail transport to ship products to market. So that's where this confirmation came from. That's where the idea came from. Additionally, nowadays, as I said, we don't call it the transports anymore. We don't call it the rails anymore. We call it transports. But we've also started to see more people using volume for confirmation of signals. It's actually quite important to this day. Additionally, people will also use other indexes. So now we also have things like the S&P 500. So people might look at the S&P 500 versus the Dow, or the NASDAQ versus the Dow, or the S&P 500. In this last point here, I just want to point out is indicators should never be primary signal generator unless also confirmed by price action. And one of the things we've been talking about, Robert just mentioned it, is the idea that price first. First thing you want to look at when we're talking about technical analysis is price. That's the number one thing. Then you can add on to that, look for your trend, and then look for your momentum, and then look at your volume. So you're always adding those things on after you've seen what you were looking for in price. So on this slide here, we have an example of exactly what Dow was talking about with the industrials and the railroads. And you can see where you want that confirmation. You want to see them both going up together and both going down together to confirm that it's either in an uptrend or it's in a downtrend. You're really looking for the two of those to work at the same time. And one of the other things that Dow is famous for is get a great analogy talking about trends. He believed that there was short, intermediate, and long-term trends, and they all influenced each other. And the way he explained it, which I think is a great way, and it makes it really easy to understand, is look at the trend as if it's the tide. Okay, when we talk about waves in the ocean, we have the tide. That's the long-term trend. And just like the tide, when it's high tide, will push the waves and make bigger waves, it's the same thing with the intermediate trend. That wave will push ripples further up the beach. That's the short-term trend. Now, when the tide changes and it goes out, the same thing happens. Those ripples will pull down the beach. They'll be pulled further by the waves, which will be pulled further by the tide. So that gives you an idea of how that interrelationship works between the two. So Robert's going to talk a little bit more about that in a minute, but let's talk about some more common trading rules, some things to be thinking about when we're starting this process of risk analysis. Robert.
Yeah, that's exactly right, Brian. And again, there are definitely some things you kind of want to have as your kind of rules of thumb. And the first thing with technical analysis is one of the biggest things is trends. That's part of your price analysis, right? Again, if you're trading with the market, or conversely, if you're trying to go against it. So just like Brian mentioned, kind of the waves in the ocean, however you want to look at it, you can also think of it like the wind at your back, all right? You know when it's smooth sailing, right? And you kind of know when there's gusts of wind trying to blow you off track, right? So that's what you're looking for in price on the charts. The next thing is being aware of the next longer trend, okay? So the important thing, we'll talk about this in just a second, but the important thing is don't get tunnel vision on one particular time frame. You always want to be looking at multiple time frames, kind of be aware of the so-called bigger picture when it comes to your charts. The next thing, volatility. Volatility, a lot of times, especially on the news, is associated with kind of the bad times, right? When you're nervous, when things are going wrong. But volatility also presents opportunity, All right, so again, don't just shy away from it. It can present things, potential opportunities and entry exit points and things like that. The next one is breakouts or sharp moves. Okay, can often signal a change in the trend. But again, and this will be reiterated many times throughout this final part 4, you want to confirm any breakout with other evidence. That's what these other tools like indicators and chart patterns and so forth, especially when you're entering a position. It kind of leads us to our last thing. There is no method out there, no indicator combination, no nothing that's ever going to work 100% of the time. So you always want to plan in case you're wrong, okay, how you're going to manage the trade before you even put that money at risk, whether it's position sizing, exit strategy, and so forth, because the biggest thing you want to do as a trader is you can't lose big. All right? If you're going to be wrong a small, manageable amount that you're comfortable with. All right, so we covered trends in part 1 of the series. So now let's kind of review one of those trading rules we just talked about, being aware of the next longer trend. And this one's kind of obvious since we're looking at it on a slide with 2 screens at once. But many traders just look at one chart at a time. So if we're looking at the chart on the left, kind of looks like we're in this nice uptrend. Okay, but if you zoom out, this is the same security. Okay, you can see this looks like in hindsight, it was just a quick retracement in a much longer term downtrend. All right, and you don't want to get caught off guard, just kind of having you being zoomed in too far. Again, technical analysis is what we call fractal. The principles can be applied to any any time frame. All right, but I think one of the most important things you can do, most useful things you do, if you're not already looking at multiple time frames, add that into kind of your process. Right, and that should improve your outlook there.
Yeah, and we've talked about this in the past webinars. One of the things is you don't want to get myopic with things. And that slide that Robert just showed is a great example of how that can be dangerous. Always remember that we do have inherent biases and we can look to see what we want to see. And that if you're looking for that uptrend and you see that first part of that slide, sure, it looks like an uptrend. But go back and take a look at the bigger picture and see, okay, is it really an uptrend? Really, and also, don't forget, you're always looking for more confirmation. So when we talk about confirmation, one of the big ones is trend confirmation. So how do we know we're in a trend? Well, one of the simplest things we can do is to just look at the chart, right? That's the most basic aspect of technical analysis is we look at the chart. And what can we use for confirmation? Well, we can draw a trend line. So we have an example here of a trend line that we've drawn. And clearly, you can look at that stock and see that it's in an uptrend. You don't necessarily need to draw that trend line. But the nice thing about having that trend line drawn on there is going forward, it can give you an idea of where there might be some support, right? Because that trend line acts like a diagonal in an uptrend or in a downtrend, like a diagonal support or resistance line. Now, when we're in an uptrend, when we see that the chart is moving up from left to right, that's an uptrend. That's a rising market. So in that case, what we'll do to draw that trend line is connect the troughs. Okay, so remember, for it to actually be an uptrend, we have to be receiving higher highs and lower lows. Or excuse me, higher highs and higher lows on the chart, right? That's the price action we're looking for. We want to see higher highs and higher troughs. And in this case, we see that. And what we've done is simply drawn a line from one trough to the next all the way up. And one of the things you want to remember here is you need to touch at least 2 points, okay? It has to touch your line. If it doesn't touch at least 2 points, it's not valid. Now, the more points that it does touch, the more strength it has, or the more valid it is. So in this case, we see that it touches it 5 times. So that's a more valid or a more strong support line or a stronger trend line, if you will. Okay, so the more times it touches, the stronger or the more valid it is. And it's the same if you're looking at a downtrend. In the downtrend, the difference would be that you'd be looking for lower highs and lower lows. And instead of drawing from the troughs, you'd draw from the peaks. And that would give you a diagonal resistance level where you could expect the price to reach some difficulty trying to get above it. One of the other tools that we use for trend confirmation is moving averages. Once again, we've talked about them in the past, but let's reiterate so that everybody's on the same page. What is a moving average? Well, quite simply, all it is it takes a look at the price action over a specified period and it averages it out and it plots it along the chart. So in this case, on the chart that we have here, we're looking at a 20-day simple moving average. So it's just taken the price action from 20 days and averaged it out and plotted it. That's the red line. Well, one of the other things that you'll notice about that red line that's interesting is, once again, it's showing that the trend is moving upward, right? We can clearly see that that red line moves from left to right in an upward fashion. And it's also provided some support along the way, right? It's acted much like the trend line that we drew on the last slide. It's the same chart, but now we also have a 20-day simple moving average showing us the same information, and it's acting the same way. It's giving us a confirmation of that trend, that the trend is moving to the upside, and it's also giving us an idea of where that resistance or support level is going to be. So in this case, because it's moving up, it's a support level. So this is the same chart now, but now what has happened? What do we see happening here? It's a few bars that have been added on to the end of it. Well, we see that same 20-day simple moving average. Now we have two candlesticks in a row that have been added on from that last bar on the last graph, and they're below. And then you have one which looks like an inverted cross or a doji that's actually literally right on that simple moving average. And a doji, if you remember from the candlesticks and charts patterns webinar, you'll remember it represents indecision. Well, there was some indecision there, but what do we see happen after that? Well, a big bar down. It now violated that 20-day simple moving average. So, Robert, why don't you tell us a little bit more about how one can use multiple moving averages?
Yeah, and this is actually very commonly discussed, especially on financial news and things like that. So, many traders will use more than one. Two is very common, and they'll observe how they interact with each other in addition to how price interacts with them. All right, so in this example, we're looking at a 50-period simple moving average as the shorter or quicker one, and the 200 as the longer term. And in this case, on this particular chart, it happens to be a daily frequency. Okay, so let's kind of take a look and see what's happening on this example here. Again, as Brian mentioned, and this is always what matters in the end, is price. All right, we're just trying to get a better read on it, so to speak. So on that red circle, you notice price starts moving up. All right, so what's the confirmation that we could potentially get? Well, the 50 period is going to react quicker to the increase in price than the 200, right? And you'll notice that in this chart. And if price continues to go up, eventually the 50 period crosses over and above the 200, right? If you've ever heard the term golden cross before, that's this type of action. When the quicker moving average is below, the slower one turns up and crosses. And in hindsight, it led to a very nice uptrend. And as Brian mentioned on the previous slides, the longer-term moving average looks like it acts as a kind of a moving trend line for quite a while until price starts accelerating away from it to the upside. But now let's take a look at the right side and let's see what's going on there. Well, eventually price starts turning down. So the first hint that something might be going on is that it crosses below the 50. Then it continues on and eventually crosses below the 200. So in order for us to try to get some confirmation that potentially the longer-term trend is now potentially changing, eventually that 50 period dives below the 200. Okay, this is the infamous death cross, right? And again, in retrospect, it doesn't always work, but in retrospect on this example, okay, it would have been a good signal to potentially exit a long position.
And one of the things people ask us all the time is, what's the best simple moving averages to use? Well, the answer is it depends, right? I know that people hate hearing that answer, but the true answer is it depends on what you're looking at and what works for what your particular situation is. I can tell you the ones that people most commonly use are the 20, the 50, and the 200-day moving averages, representing short, intermediate, and longer-term trends, and that's why they're the most common. But you'll find many people will adjust those numbers. Maybe they'll use 18 versus 20 or 22 versus 20 or any variation thereof. And really it comes down to what works for you. And you may find that you may have one set of numbers for simple moving averages on one stock and a completely different set on another based on what you've seen happen in the past. Remember, when we talk about technical analysis, it's really something that takes some time. You're really got to get an eye for it, so to speak. I'll give you a quick story. Yesterday, one of the happiest moments in my life. My son's 7 years old. He's been learning to read. And yesterday he said, "Dad, I read 50 pages of my book today." And I said, "Wow, that's great. I'm so happy." And he said, "Yeah, I get it now. I understand why you love to read. I actually could picture myself in the book." Now, that's a big moment for anybody, right, when you're learning how to read, when you can finally picture yourself in the book, and it makes reading much more enjoyable. It's the same thing when you start using technical analysis. The more and more you use it, you'll find yourself being able to get inside the book, so to speak. And when you can do that, you'll find what numbers work best for you. And it goes that way for any indicator, right? They can all be adjusted. They can all be changed. Probably in the beginning, it's best to start with whatever the most common is, just to get an idea for what that is, and then you can branch off from there and make adjustments that work for you. So one of the other really common tools that people will use to judge trend or get trend confirmation is what's called the ADX, or the Average Directional Movement Index. It was developed by Wells Wilder. He's a very famous technical analyst. He actually created quite a few different technical indicators and systems, very famous. One of the more famous ones that he created is, in fact, this Average Directional Movement Index. And really what it's trying to do is get an idea of how strong the trend is, or if it is even in a trend. It's really a measurement of that trend and how strong it is. So what it does is it takes an average of expanding price ranges, and it takes into account the positive and the negative, so the up and the down movements of any security, and it tries to represent that on the chart. So when we look at any kind of indicator, it's all derived from the same information. It's just a different way of showing it, right? This information here is just another way of showing what the trend looks like. So in this case, Wells Wilder said essentially anything that's below 25 on his ADX index is going to be either not a trend or a weak trend. So if we look on the left-hand side of the chart, or the box, now remember the indicator's below the actual price move, so the price is in the top part of that chart. The box down below is where we're looking at the ADX. And the ADX is actually represented by a dark blue, almost purplish line. And you'll see that it moves up and down. And when it's below 25 on that left-hand side, it's indicating that we're not in a trend. And if we look up at the price action, there's our confirmation, right? The price action also indicates that it's not in a trend. It's going sideways, or it's consolidation. It's not really a powerful trend to the upside or to the downside. But what do we see as we look to the right side of that red box? Well, we see that the ADX starts climbing. And it starts moving up and making new highs. It goes well above that 25 level. And once again, we said that that 25 level was important. Above 25 level is where we start to see the trend being strong, or it's more strong. And it's really a trend as opposed to maybe a sideways consolidation period. And we see the mountain goes up, it builds up. And we can see it also in the price action up above, right? There's clearly a strong trend to the upside when that ADX is high. And you'll also see it comes down a little bit, and it slows down. It actually stays above that 25 level in that little valley there, so it's still indicating that it's in an uptrend, maybe not as strong as it had been just prior to there, but it does stay up there. As we move to the right, what do we see happening? Well, it starts to deteriorate, and look what's happening. You see that the ADX line is deteriorating. It's moving down. What's happening up above? The price is also moving down. Okay, the two other squiggly lines on there, I know it can look like a lot the first time you see this. That's the DMI positive and the DMI negative. It's trying to give you an idea of whether there's more positive or negative days. So typically, when you're in an uptrend, you're going to see the DMI positive, or that green squiggly line, above the red squiggly line, which is the DMI negative. Okay, and then when they switch, that can also be a signal where you can see now the green line crosses up above the red line. Well, that happens right around when the DMI starts to cross up above 25. When the ADX crosses above 25. But also on the right-hand side of the chart, where we see the ADX come back down below the 25, what do we also see happening? Well, we see the positive and negative DMIs, the green and red lines, converging also at that same time. That can also be another signal that, hello, something's happening. Remember, when we talk about trends and trends changing, it's very common for people in the beginning to think, well, it wasn't an uptrend, it's no longer in an uptrend, I see some evidence suggesting that that's changing, it must be going down. That's not necessarily the case, because many times we'll see a sideways consolidation before it continues to go back up or before it goes down. So always remember, just because we see evidence indicating that a change may be coming, it doesn't mean that the opposite is about to occur. So we've talked a bit about some of the ways you can confirm the trend. We talked about price and confirming price and using trend to confirm the price. What are some of the other indicators that we can use, especially when we look at it from a risk management perspective?
Yeah, thanks, Brian. And one of the biggest things that you hear on probably financial news is volatility, right? And usually associated when the market's maybe pulling back a little bit, everybody gets a little nervous, right? But volatility is very useful, especially when you're trying to understand the behavior of security. If any of you are out there that, we're going to talk about stop orders in a little bit, but if you ever use a stop and you get what's called shaken out, right? It hits your stop and then immediately goes back in the direction you wanted, but you're no longer in the position, so you're kind of sitting there on the sidelines there. So, a lot of times that happens because people just use some arbitrary amount. Again, not saying that's wrong, okay, but is there a way we can try to make a better decision? And one of the things that we can look at is the volatility of security. And think of volatility as kind of part of the stock's personality. Some stocks are just more volatile than others, and then there's periods of time for that one security where it's more volatile than it might have been in the past, and you could expect it to be more volatile in the future. So a very popular indicator is called average true range. Right? It's basically based on the range of the security's price in the given observation period. The default is 14. I don't want to dive too much into the math on that. If you're ever interested in kind of the mathematics of an indicator, feel free to take a look at our technical indicator guide on fidelity.com and accessible through the Active Trader platform. But just looking at the diagrams we have here, low volatility basically means there's lower movement. Okay? Higher volatility, you can see that the bars are significantly longer. Okay? It doesn't mean that price can't trend in one direction or the other, okay? But it just means that for that given period, 14 periods, all right, each kind of day or each period has a lot more activity there. So we're going to look at an example on the next slide. And you're going to see that average true range, it's an absolute number. Okay, so higher price stocks will typically have higher numbers. Lower price stocks will have lower numbers. There's a variation called average true range percentage. Okay, if you want to take out that factor. But just look at this chart. Right, looks like kind of a nice uptrend, but in the first kind of outline box in the middle, looks like there's just a period of heightened volatility. Could be earnings, could be some announcement. Okay, and you'll notice a corresponding increase in the ATR indicator at the bottom. All right. In the middle box, you'll notice that while price is still trending up, on any given bar, looks like it's calmed down a little bit. So even though price is moving, in this case moving up, you notice that ATR is trending down. So how does this help us from a kind of a trading and risk management standpoint? Well, when it's kind of calm, you might want to use maybe a tighter stop. All right? You're not going to get whipped out as much because the stock's just not moving as much on any given day. But in times of heightened volatility, all right, if you try to use a tighter stop, you might get stopped out, either briefly after you place the trade, almost like what was the point? Okay? So understanding a stock's kind of behavior at any given point, you can look at average true range. In the demo, we'll show some other volatility indicators just to make a more informed decision on where you might want to try to place the stop or enter or exit a position.
Yeah, and one of the things to bear in mind today, everyone, is that this isn't a comprehensive study of every single indicator out there. For every one of the things that we've talked about today, there are multiple other indicators that basically use the same data and show it in a different way. And finding which one works best for you is what is going to work the best in the long run for you. Because what someone likes and someone uses can be very personal. I might use one thing, Robert might use a completely different indicator that shows the same thing. So let's say volume, for instance. I might use one indicator, he might use another. It just comes down to what you're most comfortable with and what is the easiest for you to read. So one of the other tools that we will often use from a risk management perspective is something called Fibonacci Retracements. Fibonacci was an Italian mathematician back around 1100. He came up with the Fibonacci sequence. So for all the math lovers out there, you may have already heard of him and the Fibonacci sequence. But really, the main thing we want to get out of this, without going into all the math, is it represents what's called the golden ratio. Okay, and the golden ratio is something that you can see throughout nature, in architecture. Supposedly, the Parthenon in Greece was built using the golden ratios, and that's why it's lasted so long and why it's beautiful. Some will even say that what are considered beautiful faces adhere to that golden ratio. If you've ever seen a nautilus shell cut in half, it adheres to that golden ratio as well. So it's seen often throughout nature and in architecture and different plants and animal life. Well, people have noticed over the years that we can see similar reactions in price using that golden ratio. So when we talk about the Fibonacci retracements, it's actually breaking down those golden ratio numbers. So what we do is, and Robert's going to give us an example of this in a little bit, how you can draw this, but we just essentially find our high point, we draw the line from our high point all the way down to the low point. And the computer software will actually do the mathematics behind it, but what it's going to look for is the Fibonacci lines. And those lines come at the 61.8% retracement, the 50% retracement, the 38.2% retracement, and the 23.6%. So look at it as how much of that move up has it retraced back down. And what you'll find oftentimes is, and remember, when we talk about technical analysis, it's not an exact science, so it's not going to be the exact to the penny point where you'll see a reversal, but oftentimes we'll see reversals happen at these Fibonacci lines. They act as support and resistance. So in this case, this is a prime example. If we look from the bottom, we'll look as it comes off that bottom, it goes up, it stalls out a little bit. Where does it come back down to? It comes right back down to that Fibonacci line. It bounces off of it, it goes back up, it goes all the way up, pretty much undaunted, all the way up to that 50 line, has a little bit of resistance, comes back down, goes back up, once again, makes it up to the 61.8%, has trouble getting through, it falls back down, that's where the circle is there. It falls back down, but notice what happens after it falls back down. It bounces in between the 38.2 and the 50. And you'll often find that these lines will represent support and resistance. Of course, it may be different on different securities. The more you use it, the more comfortable you'll become with it. And you'll see that it doesn't bounce at the exact price point, but it gives you an idea of where these levels can be. And that can be helpful when you're actually setting your risk parameters. It can give you ideas of where you may want to get in or where you may want to get it out based on those important levels of support and resistance. So in this example, we've drawn from the high to the low, and you can do the same thing in the other direction where you draw from a low to a high to get an idea of where something might retrace back if you think it's hit its peak. So now we just reverse the process. We draw from that low point all the way up to that high point. Once again, the computer does the work for us. It gives you the exact same Fibonacci retracement lines. What do we see happening here? Well, the same thing is happening. We see that the stock hits that top point that we've drawn to. It comes back down, and it starts to gather around that 23.6 level, breaks through it, and then it hits that 38.2. The 38.2 is now acting as support. It bounces back up, and it gets up above that 23.6 line, and it continues its march. So in this instance, we found that support at the 38.2. This is just giving you an idea of where these important levels might be. Now, you can, of course, draw your own support and resistance lines on here as well. And once again, remember, when we talk about technical analysis, we're always looking for confirmation. And we're always looking for a preponderance of the evidence. right? So if you've drawn support and resistance lines and they coincide with Fibonacci lines, that's more evidence. It's giving you more evidence to make your conclusions on. It gives you more things to confirm. So remember, that may not be exact, but you're always looking for more evidence to support what you think, okay? More evidence that confirms. And Fibonacci lines can help with that, especially if they line up with support and resistance levels that you've determined already.
Yes, I think Fibonacci's is a good time to address a common question that I get when I talk to the traders one-on-one is, does technical analysis work, right? And, so ask yourself this question. Do Fibonacci levels actually exist, or do they exist because we think they exist, so we pay attention to those levels? Well, the answer is it doesn't actually matter, right? If you choose to use it, what it does is it gives you levels to pay attention to. Doesn't mean that it's always going to bounce off this level. Doesn't mean that it's always going to, go through this level, or this means this, or this means that. You're just giving yourself a way to make decisions, all right? If you choose to use that, okay, then those are the significant levels you're going to want to pay attention to. You could draw some arbitrary support or resistance line. Does that mean the price is supposed to stop there? No, you're just identifying a place where you think there could be maybe a little tug of war, okay, and an important price level you want to pay attention to. And you can use that to make your trading decisions. And that gets us to what everything has been leading up to is actually trading, and what can we control. It's a process of making decisions, and the most important part of that process is managing your risk. So we're going to take a look at a couple of points here. And why is trade management important? And what's the first thing on there? Preserving capital. Okay, why is this the first thing? Well, if you blow yourself up by trading too big, right, well, then you can't trade anymore, and you got to go back and do something else, right? So we got to make sure that we have enough ammo to, keep putting our trading ideas to work, all right? But we can't be losing big. You mentioned that earlier. You got to lose manageable, okay, so that it doesn't wipe you out. The second part is potentially locking in profits. I mean, I talk to so many traders that they have no idea what they want out of a trade, even if it works out. Okay, so how many of you are out there, saw a trade and let a winner turn into a loser? Exit strategy is not just about protecting yourself on the downside. It's about having an idea of controlling the trade. Okay, and again, nobody ever went broke taking a profit, but if you have some idea of what you're expecting, then you can make a rational decision. Okay. And what all this does, it creates a approach to trading, a plan, a discipline, repeatable success. It doesn't matter if you have success on one trade if you have no idea why it worked, okay? And this kind of ties around and leads to the last one, which is what I consider probably one of the toughest things to overcome as a trader is when you're trading with real money, all right, you can get very emotional about it, right? So having a plan, okay, thinking the trade through, especially what might happen in a negative outcome, allows you to process that ahead of time. Because if you ever find yourself winging it, the game's over. Okay, that just leads to bad decisions. Any thoughts on that, Brian? I mean, again, for me, that's the biggest one right there. Is the last point.
Yeah, I think that's an excellent point. At the end of the day, and we're going to talk about some different types of trades that you can place, or different types of order types that you can use to help automate the process just in a little bit. But I think that a big part of it is eliminating the emotions and really taking a look at each trade individually and having your profit target for the upside and having a pain tolerance to the downside. Know how much you can risk and know how much risk you're comfortable taking. On this last slide, I think there's an interesting note. The S&P 500 returned 9.22% over the 20 years ending in 2013. But the average equity fund investor only earned 5.02%. Why? Well, it's because they didn't have a disciplined approach, right? What do most people do? And everybody says, buy low, sell high, right? But unfortunately, in the real world, people let too much emotion get into it, and they end up selling low and buying high. Why? Well, because emotion gets behind it. They start seeing prices go down. They don't want to get out because it's going down. They want to stay. Finally, they get to the point where they absolutely cannot handle it anymore. They have to get out. What did they just do? Well, they sold when it's low. And now they've probably lost a lot of their capital and don't have money to buy when now it's low. It's time you should be buying. And then on the other hand, when something goes up, a lot of times people won't sell it because they don't have a price target to the upside. We see this all the time, and I think that before you even put the trade on, establish those numbers for yourself. Before you even look at the trade, before you decide when you're going to place it, okay, I've decided I'm going to buy at X price, what else should you be looking at? Well, have an idea. How much risk do I want to have on this trade? Okay, I'm going to buy it at X price, but where do I want to get out if it goes against me? And where do I want to get out if it goes for me? Know where you're going to have those price targets, to the above and to the below. Many people will find one of them and not the other one. But in the end, you really want to know both sides of it, because that's the only way you can properly analyze how much risk versus how much reward, right? That's the trade-off. It's always the trade-off in trading, is risk versus reward. How much reward do you want, and how much risk are you going to have to take on to get that reward, or potentially get that reward? And one of the things we always want to mention, what should be the size of my position, right? Position size is one of those often underlooked things. Oftentimes people will say, I have this one position. If it goes bad, I can't sleep at night. Well, that position is too big. If you can't sleep at night, it's too big. That's a real simple trader's rule of thumb. If it's keeping you awake at night, that position's probably too big. Okay? You want to make sure that the position size is in line with how much risk you want to take. You want to make sure you're keeping those together. So now that you've thought about some of these things, one of the first steps you have to do is figure out, like we said, where are you going to get out on the downside? Well, how are you going to figure out where you're going to get out on the downside? How do you determine what your stop price will be? And we're going to talk about stop orders and the different order types in just a few minutes. So if you're wondering about stops and stop limits and all that, we will talk about it. But really, your stop price is a point that you want to predetermine that gives you an idea of how much risk you actually have on the table. How much risk per share? What is your potential downside? Now remember, when we talk about stop losses in a few minutes, we'll talk about the fact that once it gets through, it automatically becomes a market order for a stop or a limit order for a stop limit, and they have pros and cons, but they may not be exact. Okay, but you want to have an idea of where that price is that you want to get out. And some of the tools we talked about, maybe you're looking at Fibonacci's, there's support and resistance, or maybe you just look at the chart every day, and once you see the picture starting to deteriorate, that's where you set a level. Okay, if it gets to X price, if I see it getting there, now I want to get out. So I encourage you to make these kinds of decisions before the trade. If you don't, definitely you want to make sure you're taking a look at it every day and getting an idea for where is the price now, and do I want to reevaluate? Do I see the evidence working against me? And if that is the case, come up with your stop price then. Use the evidence that you have. Use the tools that you have to determine where you can comfortably get out or where you want to get out. So one of the ways that you can determine your stop price, in addition to all the ways that we've spoken of already, let's take a look at this chart here. So in this chart, we assume the investor buys this stock on the most recent candle at $4.45 a share due to positive price and volume action. So if we look at the candle, right, we see earnings came out, stock jumped up, ton of volume. Well, there's a big gap there. We talked about gaps in the last webinar. This is a perfect example of that. So it gapped up, you decided to get in, you bought it at $4.45. Where are your exit points? Now, these are somewhat arbitrary, right? Everybody's going to have their different levels, but here's two quick and easy ways you can use that give you two different levels of exposure. So if we look at stop one, you're actually looking at it and saying, okay, I want to be pretty conservative. If this comes down back below the entry bar, so if you look at the candlestick on the right-hand side, you're saying, well, that candlestick peaked out there and then it fell down. Now it popped up above. Maybe that's where I'm going to have my stop. It's just a little bit below where it opened up today. It's not giving me a ton of risk. It gets me out. Now I could get whipsawed, right? That's the trade-off. The more risk the less risk you take, the more risk you have of getting whipsawed out of something or stopped out before it actually turns around and goes back for you. So now somebody who's willing to take on a little more risk with less chance of getting whipsawed out, they might look at that level 2. So the box in the 2, now it's saying, okay, well, I see down here at this lower level, what do we see? There's what appears to be support having formed from those two candles, right? They have that same level at roughly the $4 level. It had support. It didn't go down below there. Every time it hit it, it came back up, and then it had earnings, and it jumped up above it. And there's a note here, if you read the note, it's also a 52-week low. So that might give you even, once again, more evidence to back that up. But remember, with that lower level, you have more downside risk, right? The first stop, it's not going to go down very far before you get out, so you're not at risk as much. Now, if you go to that lower level, it's about a 45-cent difference. So you have 45 cents per share on the line more with that lower stop level. So it's all going to come down to what is the stock, what is the situation, how much risk, and you have to evaluate that for every trade. And for one person, that one level might be where they are the most comfortable. Someone else might look at stop level 2 and be much more comfortable there because they're more concerned about getting whipsawed. Or it could just come down to how confident are you in this particular trade? If you're less confident, you might want to take less risk and use that higher stop out level. So I think that's a great segue to talk about risk versus reward. Let's talk a little bit about risk versus reward and how you can look at it.
Yeah, and one thing I want to touch upon on looking at this slide, and really this is going to be one of the biggest benefits of technical analysis, because typically as investors, we're taught to think of risk in terms of time, right? Hey, I'm 25, I can be aggressive because I have time to recover in case something happens, or, I'm close to retirement, I should be more conservative. Well, the only issue with that as a trader is your account balance isn't measured in time, it's measured in dollars, right? So again, the biggest benefit from a kind of maybe a trade management standpoint is technical analysis teaches you to think of things quantitatively. So you can calculate things like risk versus reward. How much am I risking to try to make this dollar? Okay, and that's what this example on the screen demonstrates, right? And who comes up with these levels? You do, right? You're deciding this based on your analysis. Okay, so again, in this example, assume you would use a stop at $57 underneath support and a profit target of $68.50. Okay, well, based on where the current price is, you can now calculate, what your risk-reward ratio is. Okay, so if your entry A was at $58.50, this would set up a risk amount of $1.50 or 2.5%. If you entered at point B at $63.50, your risk would be $6.50 or 10.2%. So if you then change this into a ratio, you have a 1-to-6 risk reward for entry A, and entry B is less than a 1-to-1. All right. So what are you trying to do here with entry A? Well, maybe you're trying to catch the bounce, but maybe there's a greater probability you're going to be wrong, right? Or if you wait entry B to try to gain maybe more, confirmation through price action or maybe some indicators or something like that. Well, if your profit target is the same in both cases, maybe you've identified that profit target line as maybe some resistance level, and that's your exit point. That influences what you expect to hope to make if the positive outcome occurs versus the risk, the loss you incur if the negative outcome plays out.
I think this is a great chart. I would point out that I think it's great from a technical perspective because if you look at entry A and entry B, we can talk about those as a risk-reward level, but also look at it from a personal level. If you were the person who got in at entry A, look at those candles to the right. You probably felt really good. The next two candles were big up days, looks great, but what about that third and fourth candles? That third candle is a pretty substantial down day. Would you have gotten shaken out there? Or would you have gotten shaken out at the next candle, which is clearly well below your profit target? So you also have to look at it from your personal perspective. For me, is that where I want to get in? I have more risk at that point. Am I going to be someone who's going to get shaken out from a couple bad days? Or do I want more confirmation and I want to wait until entry B? Because now, look at entry B. You've had quite a bit more price action to the upside, but you're buying it at a higher level. It goes back to that trade-off. And once again, it's that risk-reward trade-off.
Exactly, Brian. And one of the things that's important is, when you're trying to practice and prepare, understand that when the bullets are real, again, it goes back to that emotion, right? So, you plan out your trades. It's kind of easy to say, oh, I wouldn't have been shaken out there. I would have been fine. All right, but that's why, it takes practice. It takes practice to control your emotions and set up that plan. And that kind of leads us to one technique that many traders use on this next slide, which is the concept of scaling. All right, so scaling is basically a gradual increase or decrease in your position instead of basically moving all in, so to speak, up front. All right, and in a way, it is a form of dollar cost averaging. So you would scale into or out of the position. You can manage risk that way because if your entry is wrong and your trade concept breaks down, price goes against you, well, you would have lost a lot less than you would have if you went all in at once. Okay. Conversely, if it actually moves in your favor, all right, you're going to scale in. Okay. The trade-off is you're going to be buying at higher prices, so your hindsight profit would be less. But again, that's the trade-off. Every decision you make in trading is a trade-off to doing something else. Okay, so you need to pick what makes the most sense for you. And we're going to take a look at an example of scaling on this next slide here, incorporating kind of our technical background at this point. So in this example, say you wanted to eventually build a 400 share position. Okay, so the first entry of, say, 100 shares would say you used a 30 period and a 60 period moving average as one of your confirmation indicators, and the 30 crosses over the 60. Okay, we touched upon that earlier. A lot of people use that as a signal. Okay, and then the second one looks like the price actually pulled back. The second entry would be on the price forms a higher low, okay, to the price value right before box one. Okay, so maybe you'd enter another position there. And the last one is it rallies back up, and then it breaks that resistance, what looks like a kind of a resistance point there right above the box one there, and that might be your third entry. That's your confirmation. And again, the same principles could be applied in reverse for exiting the position. One thing I've mentioned here that's crucial, this is different than trying to double down and save a bad trade. Okay, with technical analysis, we're trying to look for, confirmation. So there's different levels of confirmation. In this case, entry point 3 has multiple levels of confirmation in addition to, obviously, price going up. Okay, if your initial analysis breaks down and fails, and then you're adding to that position, and that's a thing many people do, typically due to emotion, okay, that's not scaling. Okay, that's just throwing good money after bad, and just hoping you get lucky.
That's a great way to put it. I mean, at the end of the day, it's true. And if you look through that example, when did you buy the most shares, right? The first two entry points, you bought 100 shares each time. And then on that third entry point, that's where you went up to the 200 shares, right? Because you had more confirmation, more things were in your favor. The price action was moving up. The shorter moving average was above the longer term moving average. And you broke up above your resistance level. Right? So this goes back to what we've been saying all along, is you're looking for confirmation and more evidence that you're correct. And that's a perfect example of it, and how you can trade into it when it goes with you and you see that the preponderance is greater, and that's where you may add that bigger portion of the position. So we mentioned earlier that we were going to talk about some various order types that you can help use as risk mitigation, or at least ways to manage risk. And really the most common ones are stops and stop limits, and then trailing stops, and then various conditional order types. We're going to talk about each of them individually so we can give you a little more background on what each of them is and how they work and how you can use them. The first one is really probably the most common, and that's what's called a stop order. And the most common way it's used is as a protection against something going against you. How does it work? Well, it triggers once the equity, ETF, or whatever the underlying you're trading is, goes through a particular trades at or through a particular price that you have set. So in this case, we've got the trade ticket from Active Trader up on the screen there. You have a stop set at 180. Okay, so once the stock goes through that 180 or trades at 180, the stop becomes triggered. So what that means is now it's an active order. It's a live order, and it becomes a market order. This is the main distinction here when we talk about stops versus stop limits. The stop becomes a market order once you go through or at that level. So now, if we look at this example, IBM closes at 180 spot 50, opens the next morning at 170. This order will execute at or near 170 as a market order will fill. Now, bear in mind, you don't know exactly what that level is, right? All you know is you are going to get an execution. The good thing is you know that you will be out of that stock. The bad thing is you don't know at what price, right? If the stock kept tanking and it was gapping down far from that 170 level, you might get filled even further down. So that's the danger with the stop order is you don't know exactly where you're going to get out. Usually, it's going to be around your stop level, but it's not a guarantee. It just becomes a market order once it's activated. On the other hand, you could use a stop limit order. Now, when we talk about a stop limit versus a stop, the main difference is that when this order becomes activated, it becomes a limit order as opposed to a market order. So in this case, we have the stop limit set, the stop level, so where the order becomes active is at that 180 level. And once it's active, it becomes a limit order for 179 spot 90. So if you're looking at the trade ticket, it says 179 spot 90. I just noticed on the description on the left-hand side, it says 179.50, but it's actually 179.90. Little typo there. But ultimately, what this is saying is if the price goes down below 180, I want this to become a limit order at 179.90. Well, where's the danger there? Well, the good news is you know that the price is going to be 179.90 or better. The bad news is, what if it never gets back up to 179.90? You won't get a fill. So the good side of the limit is that you know what the price will be if it gets filled. The downside is if it gets filled. And I think a lot of times it's one of the dangers with the stop limit is that what's the reason that you're using the stop limit? Well, you're trying to mitigate some of the risk. Well, if you have a limit and it goes through it and it never comes back, have you really mitigated any of the risk? No, because you actually still own the stock and you never get out of it. What if it keeps going down to zero? I know that that's an extreme example, but you have to bear that in mind. So you want to be cognizant of that limit level. If something's really volatile, you may want to set it at a different level than something that isn't very volatile, that doesn't move a lot. And this goes back to what Robert was talking about earlier, the average true range. That can help you with setting this kind of a limit. If you see something that has extremely high average true range all of a sudden, you might want to be cognizant, if you're going to go the limit route, that maybe you don't want to make it too close to that stop level because it may blow right through it and you never get filled and you don't manage any of that risk. So remember, just to make it very simple, the stop order, you're going to get out. You don't know what price. The stop limit order, you know the price, but you might not get out. Once again, it's a trade-off. So one of the other, becoming more common these days, order types is called a trailing stop order. So what the trailing stop does is it actually will follow or adjust to the price of the stock as long as it's going in your favor, based on an amount that you set. So for stocks, the stock, if it's going up, it'll trigger a sell, or you can actually use it to trigger a buy if there's a point where you want to get in or if you want to buy to cover a short. But basically, it's going to trail it until the stock moves against you. And you can set the trailing amount. You can actually make it a dollar trailing amount or a percentage trailing amount. And whether you use one or the other, it probably will depend on the underlying, right? You might, something really volatile might make more sense to use a percentage versus something that's not quite as volatile. But once again, it will depend on a case-by-case situation. So I want to just go over an example of how a trailing stop works. They can seem kind of confusing the first time you hear about them, but they're not really very confusing at the end of the day. So let's look at this example. In this example, the actual ticket on the left is different from the example, so if you want to follow along, you'll see at point 1, the price is at $25. You buy XYZ, you pay $25, it gets up to 27. And this is a very common way that trailing stops are used to protect gains so that you get out and maintain the gains that you've already had. So in this case, it's gone up $2. You're happy, you're up $2. You decide you're going to place a trailing stop loss, and it's going to be a trail of $1. So in this case, that $1 level is going to be 26, right? 27 minus $1 is 26. So that's your 0.3. Then the stock price keeps going up. Good for you, right? As that stock price is going up, that trailing stop is going to move up with it by the amount that the stock goes up. So in this case, the stock goes up to 28 roughly. It follows it up there. Then it keeps going up. It goes up to 29. Now, it's going to be $1 below, because remember we said it's a $1 trail. So as the price goes up, it follows it up, and it peaks out at 29. Your stop is set $1 below there, which is now 28. Now your stop order just stays there. Now the price starts to decline. So that now your trail doesn't move anymore. It's locked in at that 28 level. The price keeps coming down. It gets to that 28. Your stop becomes active. You get out of the stock. So what you've effectively done is captured all that gain that you had from 25 up to 28. So you got that $3 gain per share. And what it does is it allows you to keep following something that's moving up. Now, you always want to be cognizant when you enter a trailing stop, how much does it move? Once again, it goes back to some of the earlier indicators we were looking at and using them to give you an idea. How much does something move? What makes sense as a trailing stop for a percent or a dollar based on how much that individual stock or ETF or whatever it is you're trading, how much it actually moves. So these are very common risk mitigation order types, and people very frequently will use the stops. And to the upside, you can also do limit orders, right? If it gets up to X level, I want to get out there. But an alternative also, if you just want to keep following something up, is to use a trailing stop. So we have some other order types that you can use, starting with a contingent order. Robert, why don't you walk us through some of these order types?
Yeah, before I dive right in, Brian briefly mentioned what's called gapping risk. It's the risk of movement outside of standard market hours. Just remember, none of these orders operate in those extended hours, so keep that in mind. Again, it goes back to, how do you protect yourself? Well, position size, right? Especially we're in earnings season. What's the first decision you're making? The decision is to have the risk on ahead of the uncertainty or not, or if you're going to have it on, what size? Okay, so remember, this whole thing's a process, and these can help you typically when the market's open. So one of the things that you may want to explore is maybe not just a regular stop price. We have these contingent orders that you can link to other triggers effectively. Okay, so in this example, we have a order to sell 100 CAT as a market order, and it's tied to the level of the S&P 500. Okay. The other things you could link it to are volume, percentage change, 52-week high-low. It's quite customizable. And again, the trigger will then activate the order that you place in the second block. One common thing that a lot of maybe more experienced traders that are familiar with this, a lot of times people aren't comfortable that stop orders can be seen by the exchanges and the market makers and things like that. So a contingent order is actually something you could use to kind of bypass that. You could set kind of just the mechanism of the same thing as the stop order. You would link it to that stock. Okay, the trigger would be the price, okay, bid, ask, or last, and then you would place the sell order. Okay, so that's kind of a way to kind of have a stop order with as a contingent, kind of get around that little annoyance that many people find. They don't like that. Another type of advanced order that we have, and we're going to go over these in the demo, so I don't want to spend too much time on these, is one cancels the other. Okay, so this is very useful if you own, say, a security and you want to set a profit target above the price. So say you would sell it if it gets up to some price, 250 or something like that, right? But you'd also want to have a stop loss at the same time just in case it goes in the other direction. Well, if you try to do this as a normal order, placing one, and then if you went ahead and tried to place the other, well, the second order would give you an error saying you have no open shares because they're already being accounted for by the open order. So this advanced order kind of gets around that. It has them both active at the same time, say, again, a sell limit above the price and a stop loss below. And if one were to activate, okay, the other usually is no longer necessary, so that it'll immediately try to cancel that other one. Another order type is the one triggers the other. So common use of this would be, say you're trying to buy a security, and then immediately after you enter it, you'd like to have a stop placed on it. So in this example here, you have a buy limit order, okay, and if that executes, it would immediately place a stop at your designated criteria. Okay. And what's seemingly very complex on the last one is actually, when you think about it, very logical. It's kind of a combination of two. This is a one triggers, a one cancels the other. So say you wanted to open a position that you don't have already, and then immediately would like to have a bracketed profit target with a sell limit above the price, okay, and then a stop loss, if needed, of course, below the price. So here you do the buy. If it executes, it immediately has that sell limit above, and then places a stop below. If one of the others were to execute, it immediately cancels the other one, or attempts to, just like in the one cancels the other just by itself. Okay, again, so there's a lot of ways you can manage your trades. Again, the most important thing is that plan, though. Even if you don't use an literal stop, like me personally, I just pay attention to stop levels, and then if they're approached, I take action myself. I mean, you decide how you're going to manage the position.
Yeah, and on the contrary to that, I love this last order type because it defines my risk from the minute I put the trade on. So as soon as I get into that position, I know where I'm going to get out to the upside and where I'm going to get out to the downside. And if I go away for a day on vacation, I know that those orders are in there. I have my risk management already set up. So I really like that type. If you don't use these types of orders, I would encourage you to at least look at setting up alerts so that you get an alert once a price level has been breached. Because as much as I know Robert and I, we look at the market all day, every day, but there are times when you can't and things happen, and it's nice to have something there in case something does happen. So at minimum, have some sort of a price alert set up, or have some order types in there to give you some level of risk mitigation. So when we talk about risk, there are different types of risk, and at the end of the day, the main ones are going to be investment or trading risk. So it's basically related to everything, right? There's a risk of decline. Every individual issue, everything can go down, right? Some things may seem like they're never going to, but no tree grows to the sky, if you will, and everything has the potential to decline in value. And that's the risk of every investment. Every stock has that risk. Additionally, you have the market risk, right? The market as a whole can be going up or down. And we've all heard the expression, all boats rise in the tide. When the market's going up, it tends to make all stocks perform better. When the market's going down, it tends to make all stocks underperform. And that's the market risk. So that's the idea that, yes, there can be better performers in an up or in a down market, but the overall market will have an effect on individual securities. And we have the individual risk. That's you, right? We all have risks from ourselves. Not putting in orders, not putting in alerts, not having points that we want to get out at, not defining the capital risk from the outset, or going all in on one position that we haven't fully evaluated. When we talk about this, we've been talking all about technical analysis today, but that doesn't have to be the end-all, be-all. It's only one of the arrows in your quiver, so to speak. You can still use fundamental analysis to pick your stocks that you want to get into, and then use technicals to figure out where you get in and where you get out. They don't have to be mutually exclusive, and that's just one more way that you can mitigate some of the risk, is using different types of analysis. Use your fundamental analysis, use your technical analysis, and use both of those on the market as a whole, right? Have an idea of what you think the market itself is going to do, and then extrapolate that down to individual stocks or individual ETFs, right? You want to have an idea. If you think that the market's going to go gangbusters, then You might load up on more stocks and securities or ETFs, but if you think that the market's not, maybe you put some cash on the side or more cash on the side. You also have the last one here, bad luck runs. It happens, right? I'm sure we've all had a trade where if we stayed in one more day, it would have went our way, or if we stayed in one more week, or if we got in a day earlier or a day later. It happens. Bad luck happens. And how can you mitigate some of the bad luck risk? Well, really, at the end of the day, don't put too much into any one position. Really, we keep going back to this. Manage your position size. Limit your position size. Don't go all in on one position because you have too much exposure in that case. Okay, so really pay attention to your actual position sizing. And especially if you're going to have a larger position, you really want to be cognizant of how much risk you have on the table. Really take a look at that evaluation. So in summary, before we get into the actual live demonstration, risk can take many forms. It's a pervasive threat to individual positions and overall portfolios. Technical analysis offers various indicators and tools through which risk can be assessed and mitigated. That's what we're trying to do, right? That's what this whole entire presentation was on today. And really, all four parts, really. And if you missed any of the other ones, I encourage you to go back and look at them and view them all together. And we also have various indicator and order types that can be used in conjunction to help reduce risk to positions and portfolios. That's what we've been talking about today. And this is the most important thing to remember. Risk can never be eliminated in investing. Without it, there'd be no opportunity for reward, right? If you fully eliminate risk, if you fully 100% hedged your portfolio 100%, well, in all likelihood, you would have no upside either, right? If you buy 100 shares of XYZ and you short 100 shares of XYZ, well, you have no risk, but you have no reward either. So keep that in mind. And Robert mentioned this earlier, but it is very important. There is no perfect combination of indicators and tools. There is no investing magic wand out there. There's no pixie dust you can sprinkle over your trades and make them all winners. At the end of the day, you have to use all the tools at your disposal. Get comfortable with the tools that you use, and those are going to be the best tools. The ones that you are the most comfortable with. They're the ones that are going to give you the best signals. And remember, traders and investors must determine the right combination that works best for their particular needs and risk profiles. And once again, I would add to that, it doesn't have to be all technical analysis. It can be technical analysis, fundamental analysis. Use all the tools you have. So with that, next steps, if you want to learn more about technical analysis, I encourage you, go to Fidelity's Learning Center. There is a wealth of information on technical analysis, webinars, videos, articles. I encourage you to take a look at any or all of those. So without any further ado, Robert, why don't you get us started here and bring up the live demonstrations.
Perfect, Brian. I'll bring it up in just a second. And while I'm doing that, touching upon just one last thing Brian said, that combination of indicators. I mean, it's obvious. If there was one indicator that worked all the time, all right, there'd be one indicator. There wouldn't be, 500. So don't worry too much about kind of the next best thing, or, if you have 12 indicators, I mean, you're just information overload. Just give yourself a way to make the best decision you think, structure the trade to take advantage of it if you're correct, and protect yourself if you're wrong. As simple as that. Perfect. So I have our Active Trader Pro platform up. Denise, can I just get confirmation that we're live here?
I can see it, Robert.
All set.
All right, perfect. So we just randomly, again, obviously this is not any type of recommendation or endorsement, but Apple's reports its earnings today, thought we'd take a look at it, and I went ahead and added some of the tools that we particularly talked about today. Okay, so I mean, again, first thing you should do is start with your price analysis. Again, if you would think that there is a resistance level somewhere, a support level, technically by definition, all you need is 2 points, right? Horizontally, or again, in an uptrend, or potentially a downtrend. Okay, what we've added here are those 3 moving average levels we talked about, 20, 50, and 200. Okay, below, we've added the ADX to help identify trend strength. And then below, we've added the average true range. From, again, an absolute numerical standpoint, kind of what's kind of normal, okay, for this security. Okay, the important thing to remember is we're going into earnings, right? And we're going to be potentially subject to that gap risk. So the first thing you want to look at is, well, what's my position? Do I want to have a position at all? And if I do, what size? Okay, whether long or short, right? You might want to look at what was the movement, again, not necessarily the direction, but what was the magnitude of movement in past earnings? How much could this potentially move, right? You're deciding where you set these levels, okay? You're deciding where you think your profit target is. You're deciding where you think your potential stop is. Again, all the techniques in parts 1 through 3 are culminating to these decisions, okay? If you're spending an hour trying to draw trend lines and support resistance, it's just too much time. As Brian mentioned, as you get comfortable, it's like that epiphany you get when you finally can read, or you can finally ride a bike and balance yourself without falling down. You kind of just get it, right? You should be able to do that price assessment very quickly. It's not an exact science. Don't worry about, is that 132.79 or 132.81. That's irrelevant. Okay, you're just giving yourself levels to pay attention to, giving yourself a structure to your trading. All right.
Rob?
And so sure.
Hi, it's Denise. Sorry about that. Sorry to interrupt.
No
Is there a way that you could maximize the size of your chart or make it bigger for folks?
Let me see if I can get it a little bit bigger. I think that's the biggest it'll go. Actually, let me do this. Let me close some of these indicators and see if that helps. All right, so for those of you who do kind of your own chart analysis, you would add, if you're not familiar with how to add indicators, say you use charts, but you're just looking at the charts right now, indicators can be added by clicking this little indicator tab, all right? Just type what you're looking for in this little box. Click, and you can add, as you can see, you can add multiple of the same indicator. To modify it, simply click on the little bubble for the top one here. Modify, and you can pick a different time frame. So say you're a shorter term trader. Brian mentioned there is no perfect kind of period to use. So maybe we'll get 10 period. Who knows? All right. You're just trying to find something that kind of fits what you're trying to accomplish here. And I think as far as what time frame to use, again, it kind of really depends on what type of trading you're doing. Obviously, if you're a very short-term trader, you might be interested in something like a 2-day chart, right? And you can customize your frequency. If you're less than 1 month, you can pick something less than daily, all right? Again, you need to decide what's comfortable for you, but, a lot of people will look at, say, 60 minutes on a 1 month. Okay. Almost everybody pays attention to a daily frequency. You go ahead, Brian.
To add on to what you were saying, a lot of people ask, we hear this question all the time, what time period should I use, not just for the chart or frequency on the chart, but for all of the different indicators that I'm looking at. And usually what I tell people is go with the standard defaults to begin with. Don't start. So if you're looking at something that has a 14 period as its default, like average true range, I would get used to using it with what the defaults are, because most of the indicators have been back tested many, many times by many, many different people. And usually those defaults have turned out to be the best in general. So I would start with whatever the defaults are, and then you can adjust them or tweak them as you get more comfortable using them. And you will find that you will find some indicators you actually will always use the defaults, and then others where you might adjust them a little bit as you become more comfortable with them. So I would usually recommend at least starting with those default numbers and then taking it from there and adjusting it to what works for you and your trading style. But I've seen many, many studies over the years where they actually did back tests on all the defaults, and most of the time, more often than not, the defaults ended up in the back testing to be the best numbers. And that's why most of them have been used, because years and years of people's trading have shown that they work the best in general. Now, you can get more specific, but in general, I'd start there.
Yeah, so what I went ahead and done while Brian was going over that was I was using our drawing tool, and again, one of the simplest things you use that for is the just horizontal support resistance. All right, and again, as long as you have 2 points touching, that qualifies. But as Brian mentioned, okay, the more times it touches, the more significant it may be. And again, many people are using technical analysis. So if you're looking at it, maybe other people are looking at it, and it almost becomes like a self-fulfilling prophecy. Doesn't mean it's going to not go through it, but it's an area that many people are going to pay attention to. All right? So, what I went ahead and did was I just drew a line right at the top here. Okay, it looks like it's tried to test that about 3 or even 4 times. All right, so that might be some longer-term price target. But also down here, right? And again, support and resistance is not a specific line. It can, it's a general area, right? So, that's more kind of where the stock's trading, and that might be more, if you're bullish on this report, maybe that's your price target, something like that. Okay, conversely, okay, you could use the drawing tool and put a support line. Again, what time frame you're looking at, right? That depends on you. But you're just identifying maybe a place where you might think that prices might hold, so to speak. And if you're not comfortable doing this on your own, just by kind of looking at it, all right, we do have a tool, our technical analysis tool. All right, we partner with Recognia to provide this. They're a technical analysis firm. So they have both suggested stop levels and support resistance. And it's based on their proprietary methods. But again, if you just kind of want an idea of where something might be, you can use this. And just click it. Okay. And it'll put on it some lines here. So based on their proprietary calculation, and again, there's also short-term, intermediate-term, long-term. You can get this by just hovering over the line until it kind of looks like a little lightsaber there. Just click it, click modify. But say we're comfortable with this intermediate term. Right? It's identifying this price level, okay, as one, right? And this other price level up here as the other. But again, all you're doing from a trading standpoint is just looking for a way to make decisions. Okay, so just as an example, say we use these Recognia levels, right? What is that, 125 and change or 26? Okay, 110, 11. Now let's take a look at some of those tools we looked at. You can do trade and orders, conditional trade, all right? And then here we have the different types of advanced orders. So here's that contingent where we had the example of Caterpillar with the S&P. So the trigger can be a stock or an ETF, can actually be a single leg option as well, be an index. All right, so you pick a stock. Okay, and you can see the different triggers you can pick: last, bid, ask, again, volume, percentage, 52-week high-low. Okay, so say we just do last, and you have choices greater than or equal to. Okay, so say you own this, and if tomorrow, okay, it opens at a certain price, and you're also somebody who doesn't like using stop orders because you don't like them being visible. All right, we'll say if Apple is less than or equal to, again, totally arbitrary, so 112, I'm in force. This is for the trigger now. Good till canceled, or again, you can customize it. And I would sell my Apple. Okay, sell however many shares you have, and you have your different stop choices. Okay. I'm sorry, you would just do a straight sell, I'm sorry, to do the pseudo stop market, stop loss order. Right? So if it trades anything less than 12 tomorrow, it's just going to fire a market order to sell the stock. Okay. You also have that one that Brian likes. Okay. One triggers, one cancels the other. Okay. So you can put Apple again. Okay. And again, the trigger and the actual security do not necessarily need to be the same. Okay, so it does allow a lot of enhancements and customization to the potential trades you're doing. But in the few minutes we have left, I actually wanted to show one of our very popular and useful tools is Trade Armor. Okay, Trade Armor combines features from the chart. It also kind of makes it easier to place, especially these types of trades. Okay, so say you're trying to do that same trade with Apple. Again, we have some built-in support resistance from our partners here. Okay, stock, action, buy triggers bracket. So you're trying to buy 100 shares. All right, you put in your initial order here. But instead of having to go through and fill out all these different fields, all right, you can click and move this. Okay, and you'll see that it's setting your prices there. Okay. I'm sorry, just the test account. But if you hit preview there, again, it combines a lot of features from a lot of different tools and tries to put it in this kind of singular trade management tool. So if you like to use in-depth charts, you can definitely stick with that. If you're just getting started or you want the ease of this type of order entry, Trade Armor is really a great way to save some time, okay, and plan your trades ahead of time.
One of the things I like about using it in that manner that you just showed, Robert, is if you look at the right, it shows you what your estimated gain and loss are in dollars and in percent. So if you decide, you know what, I want to make 10% on this trade, all you have to do is move the slider to the upside until it gets to the 10% level, and it sets it for you. And conversely, if you say, I'm only willing to lose 2% on this trade, you just slide the stop loss or the order that's underneath where you're getting in to the 2% loss. It makes it really simple, really easy, and it can do it in dollars and in percentage. So.
Yeah, so I think we're coming up on 1:30, so I just want to thank everybody for attending, especially everybody who attended through all four parts. And again, don't forget, me and Brian are part of Fidelity's Trading Strategy Desk. If you ever like to talk about this and discuss this, definitely give us a call, set up an appointment. We'd love to speak with you.